me, success is living in complete obedience to Jesus. It's not just looking at it from what external views of success might be, but really more what an eternal view of success would be.
God has given each of us special gifts, and it's our job to figure out what they are and where He would have us use them.
One has to trust God because nothing is guaranteed. Even health and the length of our life is not guaranteed.
Impacting the marketplace with our faith, that we demonstrate that faith every day in what we do, how we do it, that it leaves anybody that we do business with. They leave our presence with a desire to grow closer to God.
Hi everyone, my name is Tessa Needham, Operations Manager for ELO. The introductory video provided an overview of some of the ELO programs. In addition, I wanted to highlight that we recently launched the ELO Peer Advisory Group Network. This is an opportunity to join a community of leaders investing in personal growth for greater impact. You can find more information on our website, elonetwork.org. I would now like to welcome you to today's webinar, Smarter Tax-Effective Giving Strategies with Rick Goossen and Ron Haik. I would now like to introduce Dr. Rick Goossen, Chairman, Advisory Board, ELO Group, and Strategic Counsel for Nicola Wealth, who will be hosting our conversation today. Hi, Rick.
Hi, Tessa. That's a great introduction, as always.
Thank you, thank you.
All right, we'll get started with our webinar. I'm really excited about today's webinar. Before I start with the introduction of Ron, who will be doing the bulk of the presentation, let me first address the topic of living and giving. The two are interrelated. You know, it's quite interesting when we talk about living, we can talk about someone living beyond their means. So when we think about living beyond your means, that would mean things like perhaps spending too much money on consumer items, going into debt, maybe refinancing your house, sucking out the equity. So we might say that's someone living beyond their means. If someone's in that situation, then of course, it's pretty hard to do any giving. So besides living beyond your means, there's also the notion of living within your means. So that might be someone who has got a carefully budgeted plan, knows what their expenses are, knows what their savings are, and also determines how much to give. And then there's the concept of living below your means. Now, living below your means may not be that common in our consumer-oriented, consumer-driven society. You know, we're all driven to spend more. And of course, with easy financing, especially in a world of very low interest rates, it's very easy to finance things that you actually can't afford in terms of paying the entire purchase price, but that you'd like to use now. So this notion of living below your means is actually the discipline of not spending all the money you could. And of course, that would give you more options in terms of retirement, savings, and other things. Now, next, let's look at giving. So it's very interesting in this concept of giving. There's actually some simple options. And again, you know, I mentioned that I'm just comparing this simple notion of living and giving and how the two are interconnected. So when it comes to giving, there's people who give below their means. So in other words, they could probably afford to give more, but they just decided that they'll prioritize other things. Maybe things like, again, their retirement savings or second home or things like that. So they're actually giving below their means. Next category would be, you know, are you someone who gives within their means? So again, that could be someone who, you know, is really wanting to do the right thing. They've got a good budget. they have a certain amount they want to save. And maybe it's a situation where they're tithing, giving 10%, maybe giving a certain percentage less. And of course, there's always that great issue of, do you give a percentage based on the gross or the net? But we'll leave that for another day. So you give within your means. But what we want to talk about in today's seminar, and why I think it'll be so valuable and insightful, is, have you ever thought about giving above your means? It almost sounds counterintuitive. You can actually give above your means. So you can be more generous than you actually thought possible. So Ron, if you just go to the next slide. So in terms of living and giving, what we'll do in this webinar today, and Ron will lead you through this process, is to consider how to give beyond your means through smarter, tax-effective strategies. So it's not actually possibly giving more money, it's just doing it smarter and more effectively. And before I hand things over to Ron, I'll just highlight that today's webinar will go exactly 45 minutes while Ron's doing his presentation. As Tessa mentioned, please pose your questions in the Q&A. I'll be monitoring that. I'll bring in the questions as appropriate at sort of breaks in Ron's presentation, and we'll have some time at the end. We want the webinar to be as interactive as possible, so definitely fire away with the questions. I'll pose them. We'll get to as many as we can. And at this point, I'd like to hand things over to my friend and colleague, Ron Haik, who's a senior financial advisor out of our Ontario office. Ron?
Thanks, Rick, and good morning and good afternoon to everyone across Canada. Before we get started, a little bit about our firm, and this speaks to a bit of our expertise. We manage a little bit under $10 billion. These are for families, high net worth entrepreneurs, professionals, business owners. And in that 21-year period, we've got a 99% client retention rate. So certainly well-versed in this space. Before we get into specific strategies, I thought it would be useful to maybe paint how does Canada compare in terms of the giving. Now, giving can be broken down in a number of areas. Giving can be broken down in terms of total giving, which includes financial assistance. It includes volunteering your time. So when we talk in the world, we can see on the world index we're sixth. The United States leads. But what's nice to note is actually from a monetary perspective, we're 10th, well ahead of, I won't say well ahead, but ahead of certainly the United States. So when we talk about monetary donations or gifting, what are the different ways of doing it? So I've broken them down for the purposes of this presentation into three types of gifting. The first I would call at the door, and we'll get into each one shortly. The second is planned giving. And I think the final one is the one we want to really focus on today, which is what we would call strategic philanthropy. And so let's talk a little bit about each one. So when we talk about giving at the door, what does that mean? This is typically friends and family in response to a question, hey, I'm doing a marathon to raise funds. I'm doing a bike-a-thon, or someone knocks at your door at your place of work, and you write a check. That's what I would call at the door, and that's certainly important, and it's certainly timely. It's a responsive, reactive response to a specific need or specific ask. The second level of giving is what we would call planned giving, and I'm going to use Ontario as an example. I think suffices to say, it's a valid number, if you will, or the tax rates we're going to look at right across Canada. But when we talk about planned giving, a lot of people do this through a number of means. So it's important for us to understand what taxes look like upon death, because this is typically when the bulk of giving happens. On your registered assets, about 54% is taxed. That's your RSPs, your RIF, your locked-in retirement account pensions. Capital gains on the sale of or disposition of publicly traded shares or business equity or investment real estate is around 26%. And if you hold some of these assets through a corporation, so a holding company or an operating company, there could be even more significant taxes through retained earnings, the shares within there. Again, real estate, maybe operating company owns a building, and cash. And we'll look at specific examples. And in Ontario and some parts of Canada, but specifically in Ontario, there's a probate fee of 1.5% of the market value. So that gives you a sense of what taxes are lurking out there. What is tax-free still today is your principal residence, your tax-free savings accounts, should you be lucky enough to win the lottery, and tax-exempt life insurance. So those are the free areas, if you will, the 3 areas of tax-free opportunities. So let's look at the tax grind. When we look at a non-registered investment, so you've got $1 million, and let's assume it's invested at 4% for 25 years. If you had a 0% tax environment, like your retirement savings plan, for example, or a TFSA, that would grow to almost $2.6 million. However, in a tax environment in Canada, that after-tax number comes out to about 1.54. So when you start to look at a cumulative loss is close to about $1 million as a result of the tax grind. Now, why is this important for us to know what the tax grind is and what the tax loss? Because there are 3 possible beneficiaries to your assets when you choose to pass, or throughout your lifetime, in fact. And if I were to tell you that they were family, they were charity, or government, and I asked you to pick 2 of the 3, most of us would probably not pick that last one. Probably wouldn't want to pick the government as the beneficiary. So when we start to look at taxes, there's an old saying with Morgan Stanley, and I think it's very relevant to tax planning, estate planning, and charitable giving. And it says you have to pay taxes, but there's no law that says you got to leave a tip behind. So this speaks specifically to being proactive and planning your gifting. And let's look at a specific example. Let's take 2 clients, Mr. Brown and Ms. Smith. Both are identical in every way. Both are 50 years young, married with kids, they have no debt. They've got corporate earnings. They've got RSPs. They've got some corporate investments. And they're saving about $250,000 annually in their corporation. Both want to retire at the same time, same diversified portfolio, same retirement income spent, if they will, $500,000. But now let's look at the individual slight differences. Mr. Brown has 0 desire for life insurance. He believes his spouse will have more than enough. And at age 70, he's got $8.7 million in corporate assets and about $2.5 million in an RSP. Ms. Smith decided to take a slightly different approach. She invests about $150,000 annually into her corporate investments, and then she also puts in $100,000 into participating whole life policy. At age 70, she has less in investment assets, about $6 million, and the same RSP. But she also has life insurance cash value of about $4.8 million with a death benefit of a little bit over $8 million. So let's look at who's better off if, God forbid, something happens to one of them. And that's an eventuality we all know exists. So there are 3 levels of tax we need to be aware of. Personal capital gain disposition on the shares of the corporation. So recall from our previous slide, when you have a disposition of shares, there is going to be a tax on that. The second level is the corporate tax on the sale of the corporate investment. So we have the business shares, and they in themselves hold assets. It might be a stock, might be real estate, it could be all sorts of investments. But I've highlighted something that's important to note that will be beneficial to one of these 2 individuals, and that there's going to be the refundable dividend tax on hand and a capital dividend approach when we look at this. And then lastly, there's a dividend tax on distribution of assets on a personal rate. So once we've liquidated everything, we need to get those assets out of the corporation into the hands of the heirs, and it's going to be done through a dividend. So at the end of the day, if we look at those 3 levels of tax, Mr. Brown has left about $1.8 million as a result. Ms. Smith, about 10.7. And it was through specifically the difference on asset accumulation versus planning. So he had a tax rate of about 71%, whereas because of the preferred tax treatment of life insurance, Ms. Smith's estate has only paid 29%, and the impact obviously to heirs and charities is significant. So why do we bring the issue of life insurance into play here? What does this mean, and how is this tied into specifically bequests? and will planning. So there are different types of gifting options. One is through your will. You do a bequest, upon my death, please transfer the funds to X, Y, and Z. Another is through an RSP, marketable securities, or life insurance. And we're going to look at each one of these briefly. So when we look at the will, it's very simple. You leave a fixed amount or percentage of your estate to your named favorite charities. So 50%, 10%, whatever it is. The important point here is to include your favorite charities as the beneficiary for some or all of your retirement savings plan. And you can do that by electing that directly within your will or through the beneficiary form. Now, when we look at the RSP or RIF, there's really what we call a tax time bomb here, because the government does discriminate against singles or divorcees or widows. Because if you aren't single or divorced or widowed, you're able to roll over your RSP or RIF to your spouse on a tax-free basis. But it's on the death of the last one that the entire RSP or RIF is taxed as income at nearly 54%. So $2 million is left only about $920,000 to heirs. And quite frankly, people who are wealthy are only taking the RIF minimums. So what can we do? Well, you can gift the value of the RIF. So at age 71, if you had a $2 million RIF and you had a mandatory year one withdrawal, it would be $106,000. That's how much you would have to take out. Approximate net. Yes.
Sorry, Ron, if I just interject here, could you just maybe clarify a RIF and how the RRSP becomes a RIF, just in case people aren't familiar with the acronyms?
Thank you, Rick. So an RSP, or Registered Retirement Savings Plan, is what we put money away in while we're working, hopefully, and we get a deduction for that against our income taxes. So it's a sheltered plan which allows you to put all sorts of investments. But there are rules, and we have to flip that RSP into a RIF, Registered Retirement Income Fund, which has mandatory minimums that we have to withdraw. So when you turn 71, in the year you turn 71, you have to convert it into a RIF. So if that RIF was $2 million, the year one withdrawal would be about $106,000, and that net income after tax, remembering our 54% tax rate, is about $48,000. So what if in fact you actually took that $48,000 from your net income and you purchased a $1.2 million life insurance policy? What would be the net effect of that? And you said, hey, I'm going to give $600,000 of that life insurance policy to charity, and I'm going to give $600,000 to my heirs. Upon your death, you would get a tax receipt of $600,000, or your state would, for $600,000, and the heirs would net out a little bit over $900,000 and the net after tax balance of the RIF. So here's again an option in terms of thinking outside of the collective box and understanding what your net effect is going to be, or what you'd like to achieve, and then reverse engineering a more tax effective outcome. Another method that we often will see is the gift of marketable securities. So client gifts $50,000 in cash annually. They sell shares. They just decide to write a check every year for $50,000. Now they decide they're going to gift $50,000 in shares with a cost base of $10,000. So they bought a stock for $10,000. It's grown to $50,000. What would be the difference in terms of an outcome? Well, because of our rules, there would be no capital gains tax on that $40,000 gain. 10 to 50 is a $40,000 gain, half of which is going to be taxable to the top rate. You actually save $10,000 in tax as opposed to liquidating it and then giving them the cash. So you still get the full tax receipt for $50,000. Again, just thinking a little bit differently, looking at your portfolio with your advisor and saying, okay, I want to give $50,000 again this year. Is there a more tax effective way of doing this than liquidating it? One of the areas I think that is often overlooked in terms of effectiveness, and I touched upon this earlier, was showing a life insurance solution. And there's a number of ways you can look at existing life insurance. You don't necessarily have to go out and get new ones to affect some of these outcomes that you're gifting outcomes. One is to gift an existing policy, including a term life policy. And so you get a receipt for the full market value. This is where you get an actuary to come in and give you a value of that, often depending on the kind of health condition you're in, that the market value can fluctuate significantly, and that's why it's important to get a fair market value assessment from an actuary. You would continue if you are making the premiums on a regular basis. You would get the charitable receipts for any future premiums. You could gift a new policy. So if you're healthy and you're insurable, you say, okay, I'm going to do a new policy, and so this is annual premiums eligible, again, for charitable tax receipts. You could gift the insurance death benefit, which we've talked about. And the tax receipt issued for the entire death benefit would offset your estate taxes. Now, what's important to note about the points 2 and 3 above, with just gifting a new policy or gifting the insurance death benefit, it still allows you as a donor to have control over policy. And that is important for a lot of clients because we don't know what life holds. It might be important to make changes down the road. Maybe there's been family circumstances that have changed, and that's why you want to make sure you still have control over that policy. And if you donate the death benefit through your will, or you can designate that charity under the policy. You can do it through both ways. However, if you designate it through your will, again, probate fees in Ontario about 1.5%, but maybe just as important would be the dependent relief claims. If someone wants to take a claim against your estate, and you're gifting it through your will, there may be a delay on that. A relatively recent piece that I would suggest, and this is a shout out to a colleague of mine in the industry, is using your Canada Pension Plan for philanthropy. So if we think about what Canada Pension Plan is, you've retired, you started to collect it, you're receiving it, it's taxed as income. Maybe you're investing it because you don't need it. And then that investment growth is being retaxed. So the consideration should be given to using that Canada Pension Plan. And that maximum pension allocation this year is about $14,436 per individual. And you can use that CPP income to create a charitable gift of life insurance. For example, a 65-year-old couple can get about $1.4 million policy, which is a meaningful windfall for their family and charity. So when we've talked so far, we've talked about giving at the door, and we've talked about gifting. But what about strategic philanthropy? And when we say strategic philanthropy, it's a little different in that you need to incorporate this discussion at every meeting with your advisor. So if we look at a typical financial life cycle for entrepreneurs and business owners, there's a situation where over time, they're accumulating assets, there's a sale of a business, and there are certain opportunities or trigger points that might make sense. We'll go through a couple of them now, but we always want to be mindful at every discussion, if there's a philanthropic desire, can we do it in a more tax-effective way? And how do we do that? We do it through, quite frankly, integrated planning. When you look at investing, often people just look at investments, or they're just going to look at the retirement income, or they're going to work with their lawyer just on their will, or they're going to talk to their accountant just on their tax reduction strategies. It's really important to connect all of these pieces at all times. So for example, if you're looking to exit out of your business, so that's succession planning, working with your accountant. That's possibly financial planning, certainly, but it's a real great opportunity to start looking at estate planning and specifically philanthropy. Are there opportunities through the succession planning and structuring your business right now to reduce taxes while at the same time creating a long-term legacy? And through the use of something like a private giving foundation, so at Nicola Wealth, we have a private giving foundation, which is a donor-advised foundation. Many communities have donor-advised foundations. They're a wonderful way of looking at things. Ours is, of course, like anybody else, a Canadian registered charity. It accepts donations, issues tax receipts, and then makes grants to other Canadian registered charities. But it allows you strategically to maximize the tax benefit of a large contribution in a given year. So you decide, okay, I've got an exit now of my business. I'm going to make a very large donation into my family private giving foundation or my donor advised foundation. And over time, I can give that money away rather than having to give it away in the year I've made the donation. So you can grow your legacy, make those donations during lean years, and continue to give in perpetuity. If we think back to, the time of Joseph in Egypt, 7 great years followed by 7 lean years, it resonates. We sometimes need to put away during great years so that we have the opportunity to help others, even in years when we have lean times. So when we start talking about donations, they can be made in cash or in kind, whether they're mutual funds, stocks, bonds, real estate, insurance policies. But an often overlooked one, I think, for many business owners is that you might actually be able to donate your private company shares. And so if we think about you started a business, the adjusted cost base is $1. You've grown this business to millions. This is going to be a large donation opportunity, a large tax bill. Often, if you can work with your advisors to donate private company shares in advance of that exit, there may be an opportunity to achieve multiple objectives, which is to help from a philanthropic perspective while at the same time being able to reduce your tax bill. The nice thing, I think, about our foundation, quite frankly, unlike a community foundation, is there are no administrative costs to the clients. Nicola Wealth bears the full costs and administrative services of our private giving foundation. It is a part of us giving back. There is a cost to run these things, and we bear that cost, so it's important to know.
So Ron, just before you go to the next slide, I was wondering if you could address one issue. So we have a lot of clients sitting in. We also have a lot of people from charities. So what I'd like you to talk a little bit about is how we work with nonprofits and their donors, because the thing that we've learned over time is that you have individuals who are very supportive of a particular nonprofit. And the nonprofit realizes that this individual has a lot of capacity, but they actually don't know how to give more than they actually think they can. So this is, so how do we collaborate with nonprofits? So in effect, we're helping both the client, the donor, and actually the nonprofit too. Maybe just talk about how that collaboration can work.
That's a good question, Rick. So often what will happen is a not-for-profit will reach out to us and say, hey, we have a couple donors or individuals who are, thinking about donating. Maybe they don't have the kind of sophistication or team around them to find the best solution, because there isn't one solution to donation. Ultimately, what the not-for-profit wants is to get a donation, hopefully a sustainable one, perhaps, as opposed to a one-off. So it's working with those not-for-profits who reach out to us and saying, okay, can you speak to our client or clients and talk about the different ways, very much like what we're doing today, Rick. And then transitioning to a one-on-one discussion with the potential donor to say, okay, let's look at your current circumstances. What is the best way for us to affect your wishes while meeting the objectives, your objectives, and at the same time benefiting those. So
the one thing I would add there, which this is a bit of, especially for nonprofits, it's a bit of a delicate dance in the sense of when you have a professional advisor come in, like Nicola, we can recommend strategies. We're not telling anyone what to do, but rather here's tax effective strategies you may wish to consider, which will actually allow you to give more to this particular nonprofit, maybe also reduce your tax burden. But it's always much better if we're the ones doing that rather than the nonprofit seem to be acting in a self-serving manner. So this is where it's this delicate dance where, we're professional advisors. Ron's got all the qualifications, as do the rest of our team. So we're giving professional advice that can be helpful to someone achieving their financial objectives. I'll just mention quickly, we have exactly 15 minutes left. Ron's getting close to the end of his formal presentation, so to speak. So we've got lots of time for questions. So I have a number of questions, but definitely fire away on the Q&A and we'll integrate those. So sorry, Ron.
Great, thank you, Rick. So when we talk about private giving foundation, and Rick, you just said something that really resonates, which is it's not a one or the other sometimes. Sometimes it's a combination of multiple strategies. And the next one that I'll share with you, we often see with a private giving foundation or a donor advised fund. And that is, you talked about how do I give beyond my means? How do you make $100,000 donation that costs less than $10,000? We looked at insurance, but you know what? You're not really getting that benefit or the opportunity to see that benefit. You're no longer here, but there's another way of doing that. And often people say, how is that possible? And so this example that I'm going to share with you is through the use of what's called Flowthrough Shares. And it's important to get proper tax advice. But here's a summary, essentially, high-level summary in Ontario of an individual donation to an Ontario charity. The individual would pay about, maybe I'll just, before I actually get into the numbers, explain what a flow-through shares are and how do they work. So the government of Canada has a wonderful program where if you want to go out and support a mining operation, there's tax credits, certain tax credits available to these companies. So what they do, there are companies like Pear Tree is one of them, and I'm not certainly recommending one or the other. This is just their example. But you could look at a situation where they bundle these mining tax credits, and the taxation system that we have allows this outcome, which is essentially for an individual in the top tax bracket, if they were to make a $422,000 purchase, upon this immediate sale of the shares, they get an immediate sale of the shares, they get $163,000 back. So the net cash position, post-closing of the sale is about $258,000 out of their pocket. But they get a tax credit. And you can see that tax credit is nearly $280,000. So they get an after-tax cash flow in 2021 of about 2022. The tax payable on that part, based on today's inclusion rate, is about 32. So their total out-of-pocket cost is a little less than $10,000. And the charity immediately receives, so this is not upon death or anything, immediately receives $100,000. So what this shows, I think, is that there is opportunities, there is complexity, and you shouldn't do any of this alone, in my mind, because it's not just complex. There's some fluidity. When we think about tax rates are always changing. We didn't see any changes to in this proposed budget, but there's changing tax rates, and you do need that expertise. And it's really important to engage individuals and a corporation and a business that has this kind of thing, doesn't do it on the side of their desk. This is a full-time business and they understand what they do. So with that, I'll turn it over to you, Rick.
Great, thanks. So just to circle back to what I mentioned at the beginning of the presentation, this notion of living and giving. So obviously for all of us, we need to decide what's our living standard, and will we live beyond our means, within our means, or below our means? And of course that impacts how we would approach giving. So we've discussed an opportunity to actually give beyond our means. So one thing I mentioned is, for those of you listening, if you want further information, you can connect with Ron or myself. We've got our email addresses there. And if you don't remember the email address, just go to our Nicola site and you'll find us there. So we have about 9 minutes for a few questions. We like to always start on time, end on time, that type of thing. So I've got a couple of questions, and one in particular that I think people find interesting is, so what is the most common mistakes that you see people make? So we know what to do. Maybe not everybody knows, but they have an idea. But what's a mistake that you see that could be avoided?
I think the one common thing, and I hope this theme came out, is they're not planning. So if we think about business planning, we're thinking about 3 to 5 years. We got business plans, and we think about financial planning. Often, what we see is that gifting is not planned. As I said, it's reactionary, maybe at the door or through a will or through, okay, the sale of the business is happening, it's sold, now I'll give some money. because I've unlocked it. And I think if you involve your advisors early on and on an ongoing basis, and they get to know you, truly get to know you, then there's multiple opportunities throughout your lifetime to change your giving strategy into more of a strategic outlook, a strategic philanthropy rather than a reactionary philanthropy.
Mm-hmm. Now, in terms of life insurance, I don't think a lot of people think of life insurance as a giving tool. Most of us, of course, think of life insurance as it's just insuring someone's life and they pass away and some beneficiaries getting paid. But is that a commonly used strategy, or is that really something where, because to me, it seems like something that so simply a person can give far beyond their means. There's a cost of the policy. They happen to die, $1 million, it can go to charity. So maybe just to talk a little bit more about the role of a life insurance strategy.
Again, I think it comes down to integrated planning. So you may have life insurance in place right now because it meets a specific need. It's funding a buy-sell agreement on your business. It's funding a liability, maybe your mortgage. And some people say, okay, well, that liability's done. I've got out of the business, or I've gotten, I paid off my mortgage. And so you can use life insurance in many different ways. There's different types of life insurance. There's permanent, there's term. Life insurance is sometimes sold just by life insurance agents, and they're great at what they do. So this isn't a knock against life insurance agents. But when you step back with a qualified financial planner who's looking at the bigger picture, who understands and works alongside your legal advisor, can work alongside your accountant, and knows, okay, strategically, this is how the family wants to move forward in life. And life isn't just about business. It is also about, things that nurture the soul. And it might be through philanthropy. It might be through giving time. If we know that as your advisor, then the implementation of life insurance as a solution to meet a certain objective or objectives, because again, those objectives change over time, we're then able to execute on those at the appropriate time. And we might even shift gears. As I said, you might have a life insurance policy that you think you don't need anymore. Maybe now's the time to revisit that.
Well, and one thing that is quite interesting is how generous people can be through their estate planning. So what I've seen over the years is that I think a lot of times people think of giving simply, while they're alive, from their annual income, they determine how much they can give. But in fact, we know that people can be extraordinarily generous through their estate planning. And in fact, there's many examples in Canadian history going back to, McGill University, which is a bequest from the will of James McGill. So there's all these famous examples where someone was extraordinarily generous through their estate. So maybe just explain or affirm this notion of, upon somebody's death, there could be lots of tax liabilities. And so when you're doing the estate planning, there's an opportunity to say, I might be able to give literally millions of dollars away to reduce the liability, the tax liabilities on my estate. So maybe just talk a little bit about that so people understand you have an opportunity, like you mentioned, instead of paying the government, you could pay one of the fine charities that are listening in.
So if we recall back to one of the slides I shared, an individual who owns a business, upon their death, if they're not structured properly, 80% goes to the government through taxes, or as much as 79%. With proper planning, more of that can go to your estate. So we're not necessarily saying go out and buy more insurance or necessarily go out and spend more or give away more. But it's also about working with the charity of your choice and understanding what their needs are, because there's transformational ways of gifting. So I could give, for example, $10,000 a year. They have a need right now. Or would I be better off working with the charity to say, hey, I'm going to give you $5,000 this year, and the other $5,000 is going to go towards a life insurance policy, which will eventually pay off at some point. That's a transformational gift, that policy, if you're paying it off over time. And so it's an understanding what's important to you. So, it doesn't necessarily have to equate to reduction in taxes, but we can do both. In life, we have what I call multiple competing priorities. I want to reduce taxes and I want to give to charities. Well, fortunately, those are sometimes go hand in hand. So again, working with an individual who is a trust and estate practitioner. There is a worldwide certification body called the Society of Trust and Estate Practitioners, someone who has that background to be able to say, okay, I understand the Canadian, if we're in Canada, the Canadian complexity around that, or I understand the international if you've got some international exposure. Sure, it is important to reduce taxes, but to what degree? You may also have a desire to help your children out, for example.
So we've got just a couple of minutes left, but I did want to highlight one point for all the nonprofit leaders who are listening. To me, this whole conversation reflects the fact that nonprofits, and of course all the great ones do this, should focus on relational giving, the relational context, because you can tell from the conversation that we've had and the information that Ron shared, is that the better you know the donor, one of your supporters, and what they're looking at, the more you can work with them. So what I found over the years is that when nonprofits come for what seems like a one-time ask, we've got a campaign, we're raising $1 million. Can you support us to the tune of 10,000? Well, then it's a bit of a binary approach. It's either yes or no. And often, unfortunately, people may say no. But if you build that relationship and work with the donors and actually show them how they can be faithful supporters and very generous supporters in a way that actually works with their tax planning, that can be extraordinarily compelling. So I just, throw that out there to all the nonprofits listening. And of course, a lot of you, are probably doing that already. So I'm not implying you're not, but just as a reminder, align yourself with some good advisors who can help donors understand this. So we've got a couple of minutes left. We're going to end on time. I'll just give Ron one last minute to just do a bit of a wrap and maybe highlight, a major takeaway.
Maybe the major takeaway really here is that complexity and fluidity. And I want to maybe reference what happened on Monday. Many of you might know that the Liberal government, the minority Liberal government, has announced a budget. And one of the things that was not included on there, and not surprisingly, was a capital gains inclusion or change to the capital gains inclusion rate. And that's not surprising because it looks like this is going to be a pre-election budget. What I will tell you, regardless of your political leanings and your belief in terms of where we should pay in terms of taxes and so forth, it is likely going to happen. If there's a majority government of some kind, you're likely going to see a change to the capital gains inclusion rate once there's a majority government. Now, what does that mean? It means that some of these strategies, like gifting marketable securities, don't change because of the capital gains inclusion, but there may be different scenarios based on your business and what you're looking to take out of your business on a go-forward basis. So the capital gains strips, there's all sorts of planning that you can do today in advance of these things to shelter your ability to gift. And so there is complexity, and we're here for you at any time, and reach out to any of your advisors.
Great. Thanks, Ron, for that excellent presentation and summary. As Ron mentioned, we can be reached via our website. Our emails were posted earlier, just first initial, last name at nicolawealth.com. And we'll sign off now. And when we do, immediately there will be a survey that will pop up. We'd appreciate your feedback on this webinar. And if you have detailed questions you'd like to pose to us, obviously email us. We'd be happy to connect with you. So at this point, it's exactly 9:45. Surprisingly enough, I'm sure to many of you, start on time, end on time. So thanks a lot for your participation and have a great day.